The modern stock market is a fire hose of variables. Every day, investors are bombarded with data on inflation, central bank policy shifts, and the intricate movements of global supply chains. Conventional financial wisdom suggests that to make money, you have to be a fortune teller. You're told to predict interest rate hikes, anticipate election results, and time your moves around the latest trade war. Then there is Warren Buffett. He has built an $82 billion fortune and sits on a $100 billion cash pile at Berkshire Hathaway. But if you ask him what the economy will look like in 6 months, he will tell you he has no idea. He treats analyst estimates as mere variety show entertainment and admits that short-term economic forecasting is impossible. Over a 54-year partnership with Charlie Munger, the pair has never made a single business decision based on an economic prediction. If the most successful investor in history completely ignores the macroeconomic guessing game, what game is he actually playing? Buffett's strategy is built on a single realization. He doesn't buy digital ticker symbols or abstract lines on a graph. He buys physical, breathing businesses. To understand a multi-billion-dollar stake in a company like Apple, Buffett uses the mental model of a simple farm. A farmer doesn't stand in the field every morning yelling at the corn to grow faster, and they certainly don't call a broker every afternoon to ask what their land is worth today based on the morning news. This illustrates intrinsic value. Rather than watching daily price quotes, look at the underlying reality: soil quality, equipment efficiency, and crop yield. Over a 20-year holding period, the daily market noise becomes irrelevant. The jagged stock ticker fades, leaving only actual productivity. Shifting from the mindset of a trader to that of a business owner removes the anxiety of market volatility. You aren't gambling on tomorrow's price. You are holding a productive engine for decades. But if an owner chooses to ignore the news, how do they know when to act during a market panic? Buffett illustrates this through the example of a McDonald's franchise. If you own half of $1 million business and your partner panics, offering to sell you their share for $4,000, you buy it immediately. You don't stop to ask what the Federal Reserve thinks about interest rates. This is why Buffett aggressively buys back Berkshire Hathaway shares when the market price drops below the business's actual value. He is simply buying more of a good thing at a massive discount. This requires a filter Buffett calls the circle of competence. He has famously avoided early investments in sectors like cloud computing, even while admiring Jeff Bezos, because he simply didn't understand how the industry would evolve. Missing a massive growth opportunity in an unfamiliar industry isn't a mistake. It is the discipline required to protect capital from errors that occur when you stray outside your expertise. Success requires 2 filters: ignoring irrelevant economic data and avoiding what you don't understand. This leaves only obvious opportunities. There is a physical prerequisite to this philosophy. You can only afford to ignore a downturn if you are never forced to sell your assets during a bad year. This is Buffett's fortress. He maintains over $100 billion in cash for emergencies, ensuring Berkshire is never at risk. An individual builds their own version by eliminating credit cards, paying off their home, and securing an emergency fund. This cash buffer is the only way to survive a 20-year holding period without panic selling. It provides the psychological security to stay the course when the rest of the world is reacting to headlines. True wealth building is inherently boring and entirely disconnected from the news cycle. It requires building a personal financial fortress, buying good businesses at fair prices, and having the patience to ignore the rest.